Amir Vardi, so I'm the head of structured credit for the Credit Investments Group, which is now part of UBS Asset Management, previously called CSAM or Credit Suisse Asset Management. This is my second. I was here last year, and this is my second year. This year in particular, it's important because we have some US CLOs that we are making European compliant. So we will be able to, after a hiatus of 7 or 8 years, sell into Europe, our US CLOs. So here to meet the European investor base and also enjoy Barcelona. So I think market size, best guess is it kind of stays flat. There's just so many deals that are in their post-reinvestment period that are amortizing quickly and getting called. So as much new issuance activity as we see, we're really just running on a treadmill. Middle market, I do see as being a larger component. Really, middle market CLOs are a financing vehicle for middle market funds. Those are BDCs or various other funds that are buying private credit or middle market. And they're increasingly using the CLO market to finance as opposed to unilateral financing from banks. So I continue to see that increasing. It's about 10% of the market. I think that just becomes a bigger and bigger share, approaching 20% of the market. As far as primary and secondary volumes, I think are likely to continue to actually increase. If you look at CLOs versus some other asset classes, the trading levels as a percentage of the market is quite low. Like high yield is multiples higher if you look at kind of turnover of the tranches. And the reason I think that could go up in CLOs is the holder base historically has been very buy and hold. They still exist, the banks, insurance companies, but there's much bigger involvement of asset managers, ETFs, and they naturally have higher levels of flow. So I could see that across all tranches, maybe to the exception of equity, increasing over the next couple of years. Pretty much always think AAAs look attractive relative to comparable low-risk products. So I do think AAAs in US and Europe, despite having tightened a lot, still have value. BBs continue to have value. So if you look at traditional historical metrics, there's less value in the middle and more value at the top and bottom. In particular, European BBs still do have some value where you can get high 600s DM with a little bit of an original issue discount. In the US, that's quite a bit tighter. It all comes at par. Also see some value in European BBs. In select cases, and actually some secondary US BBs, older deals that we think are getting called. We think there's some value there. Also, lastly, primary equity is getting more interesting. It's been not quite that great in the last couple of years, and moving into this year with tight cost of funds, really the tricky part's buying the collateral, but if you can accumulate a nice pool of collateral, primary equity can look pretty good. Depends who you are. Opportunities for private credit funds to finance in the middle market space. Spreads are really tight if you look at middle market versus BSL. So opportunity for them to decrease financing, get more leverage, get better leverage. Opportunities for new managers to come into the space. There's certainly a reception to new managers. People are waving in. There's a lot of demand for paper and the basis is quite skinny. So if you're a newer manager, this is your time really to build your business, and also an opportunity to differentiate yourself based on credit picking. So we've had a few cycles. Right now things are strong, but as we come out of this, there certainly will be differences. There always has been differences, but some of the new managers can prove themselves. Some of the older managers can continue to prove themselves.